Back to another episode of Hard Money Dispatch, the show that demystifies sound money and helps you see the system for what it is. Today's guest is Charli Andrys, and he is the founder of 21st Financial, an investment advisory built for Bitcoiners and the Bitcoin curious. He's been in Bitcoin for quite some time, discovered it from a very young age. I'm sure he'll have some interesting things to talk about today. Charli, welcome to the show.
Thanks so much for having me. I appreciate it.
So you're only 22 today, but markets have been your obsession since you were 13 or 14. What pulled you in that early? Most people don't even know what financial markets are at that age. And how did Bitcoin fit into that picture?
Well, it's so cliche. I had a lawn mowing company when I was younger. And so that was kind of my first introduction to anything entrepreneurial at all. And it gave me something to do when I was younger. And, as a 14-year-old kid, I had access to YouTube. So one of the first things pushed on me at a young age was kind of like financial content, you know. And so I kind of got into it that way, investing in Microsoft and Nvidia and Apple and all those stocks, and probably my Robinhood account under my mom's name. So that's kind of how I got started in finance. And I was always kind of the financial nerd in high school. And, I even remember my high school teachers asking me about Bitcoin when I was a senior, junior in college or in high school. And I remember telling them, like, I think it's cool, but I think the United States government will come out with something better. And how wrong was I, right? And so that was kind of my first introduction to Bitcoin. And I was always interested in markets, all sorts of markets. I traded penny stocks for 4 years and got pretty consistent with that, So I kind of got the background, nitty-gritty market knowledge from a young age. And I always wanted to do something in finance, whether that was, being a stockbroker or, doing something in finance. I always thought it was super interesting. And the fact that you could kind of like make money with money was super interesting to me. And so, yeah, I wanted to go to college for finance and entrepreneurship. The summer before, I was working a landscaping job. And this is when I first remember kind of hearing about Bitcoin is, I'm working on the mower for 40, 50 hours a week and you got your headphones on. So you can't listen to music for 50 hours a week, or at least I can't. So I looked up audiobooks, and podcasts, all sorts of stuff about Bitcoin, and completely fell into the rabbit hole. And so that's what I did all summer, hundreds of hours of Bitcoin, education. And so I became obsessed with that. And that's all I wanted to do after college for a career. And actually, when I got to college, I had to move to Grand Forks, North Dakota. That's where I'm at now. I actually got a part-time job at a Bitcoin mining facility. And it's funny, at the time, I needed a part-time job. So I just went on ZipRecruiter or, Indeed. And I think I searched up Bitcoin. And there was probably 1 or 2 jobs that came up, and this was one of them. And so I just emailed the people, reached out to them, and we set up an interview, talked Bitcoin for an hour or 2. And they really liked me. And I was able to come on and, really learn about it, learn about the industry and the nitty gritty background of Bitcoin, because I just wanted to know all about it. And, it gave me something to do when I was in college. So, yeah, that's kind of how I was started in Bitcoin. It was about 2022, that summer of 2022.
Okay. So, yeah, I was going to ask there earlier, how did you get a brokerage account as a minor, 13, 14, but your mom trusted you enough to give you access to her Robinhood?
Yeah. Yep. Yeah. She was always super supportive. So was my dad. So, yeah.
Wow. That's great. And it seems like it worked out. So you mentioned working in Bitcoin mining. You helped operate about 20 megawatts of mining across the Midwest and Texas. What did working hands-on in mining teach you about Bitcoin that a lot of people might not ever see?
Yeah. It was such a great experience. I worked there for about 4 years, or not 4 years, about 3 years. People say Bitcoin's backed by nothing, and I just laugh, because after working with the physical real, side of Bitcoin, you're working with real electricity, you're working with real hardware. These are computers, so you get to see the real side of Bitcoin. Bitcoin is a real cost of production. It's basically a global subsidy for energy, cheap energy everywhere. So that was super interesting. Miners are so price sensitive. You get to see not only the economic side of, mining, but you also get to see, the difficulty adjustments playing out in real time. You get to see, all sorts of stuff, that a lot of people, let alone, investment advisors get to see. And so that was just an awesome experience, seeing proof of work at scale. And, and the Sundog mining team was super small, super entrepreneurial. I think I was probably their fourth or fifth, maybe sixth employee that they hired on. So I was able to see, the business side of it, the operations side of it, all sorts of stuff like that. So it was a great experience. Yeah.
And then you left Sundog Mining to manage your portfolio full time. What'd you learn once it was your own capital on the line? How does that change things?
Yeah, so I never actually managed capital for Sundog Mining at all in any sort of capacity like that. Managing your own money is like a whole new thing, right? And you're responsible for your own decisions. You are, you know, responsible for what happens to your portfolio. So you're gonna make mistakes, and the point of it, is just kind of learn quick and remember the lessons you learned because you're gonna fail. So it's kind of like what I learned right away. I had some experience, managing my own portfolio, these years up until now, and so it was a pretty seamless next step.
Do you look at the most? Like, are you a charts technical analysis guy? Are you more macro, just looking at the big picture, or how do you work in that regard?
I used to be a real big charts guy, all charts, all technical analysis. And, that's a lot of what I did. It was, trading, day trading, penny stocks, small cap equities, low float stocks. A lot of it is just getting all your data into Excel, looking at your data, finding an edge in that data. And that's all I did for the longest time. And it's so funny because now I'm, kind of on the opposite end of it. And I'm looking at a lot of macro stuff, and Bitcoin kind of fits into both of them. It's like Bitcoin's has a very strong macro case. You look out into the future, they're going to print money. So you probably want to hold something that's finite in supply. So that's why, hold Bitcoin. Jordy Visser talks about this all the time, shout out to him. The long scarcity, short abundance kind of trade. So you want to think about anything that's becoming abundant in today's age, think about AI, right? What is software as a service? What's that worth now when everyone can make apps and software for cheaper that's custom tailored to them, and they don't have to know how to code. Like I made an app the other day and I don't know how to code at all, so it's interesting like that. But yeah.
Yeah, they even have a name for it now. Wall Street came out saying the debasement trade, which has been a thing for a lot of years that a lot of us, well, especially in Bitcoin, have known about. And same thing with precious metals investors, I suppose. And interesting that they've finally coined that term or finally caught on. But yeah, I talk about this all the time. The only thing I understood about Bitcoin back many years ago when this all began for me was that it had to be mined into existence, required energy, and that there was a finite supply. And that was it. And I thought if that's true and digital scarcity's been created for the first time, then this is going to be a really big deal, and everything should continue to collapse in value against it. And it's been really fascinating to see that play out and how fast things are developing. So getting back to your story, when you say you help clients build a retire on Bitcoin plan, what does that look like in practice, and how is it different from just buying and selling spot?
Yeah. So, people retire on equities and government debt today. So retire on Bitcoin isn't anything crazy, in my opinion. Stocks, bonds, that's like the standard playbook. So why can't you retire on Bitcoin as well? So whether that's, say you already have a traditional portfolio and you're looking to implement Bitcoin to make your portfolio better, or if you're already a Bitcoiner, you can retire on Bitcoin, so in a ways that you don't have to rely on selling your Bitcoin too. So the whole antithesis of Bitcoiners is, right, it's like, don't sell your Bitcoin. It's the farthest thing from the sell button for me. So how do we really retire and structure a portfolio, thinking about it into the future? You want to talk about taxes, you want to talk about cash flow, kind of getting it all in one package so you can have a professional kind of help you manage it.
Okay, that kind of leads into the next question, which is, some critics say Bitcoin doesn't produce income, doesn't have cash flow, therefore it's worthless or it's not a real investment or whatever. Why do you think that's wrong? And also, how do you retire on Bitcoin given that, there's no dividend payments or stuff like that?
Yeah. So, gold doesn't produce income either. Cash sitting in a vault doesn't produce income either. Doesn't make them useless assets. And people who say Bitcoin doesn't produce income, I'd laugh and I'd say you're right. Neither does your real estate though either. You have to put in real work in order to cash flow that real estate. You got to find a tenant. You got to vet the tenant. You got to maintain the tenant. You got to maintain your own property. You got to pay for insurance, and you have to deal with all the risks like, fire, flood, hazard. There's all sorts of weather risks associated. It's a lot of work. So it's not crazy to say that you can also do the same thing with Bitcoin, right? If you just buy a second home, it's just going to sit empty. It's not going to cash flow for you. And if you wanted to, without doing the work, you'd maybe hire on a property manager and pay them 7-8%. And so, you kind of think about me like your property manager, but for Bitcoin, except instead of paying me 7-8%, you pay me a little over a percent. And so there are a ton of things that exist in the marketplace now, a ton of instruments. There's the preferred equities. There's a ton of derivatives instruments built on these new ETFs. There's a ton of optionality. If you want to hedge for downside, we can do that. If you're a 65-year-old retiree and you want to benefit from Bitcoin, maybe spot Bitcoin isn't the right thing to do. Maybe you want something like a structured preferred perpetual equity, and you maybe get 11.5% per year instead of having to deal with the volatility and maybe getting 20% per year. So there are a ton of different things we can do, a ton of optionality, and it's not just a one size fits all anymore. You don't just have to put Bitcoin in your portfolio and pray anymore. It's kind of, there's a refined market now to benefit from Bitcoin without having to hold the volatility.
Does borrowing against Bitcoin play into that at all? Or is that something you advise clients on sometimes?
We're kind of finalizing partnerships. Some of our multi-institutional custody partners, will offer something like that. It's not usually something that I advise as a client, just because, I've heard a lot of horror stories about lending against your Bitcoin. We're seeing it now with Bitcoin at 60,000. It was, I don't know, 126,000 in October. So if you were able to take out a loan against your Bitcoin at 126, you might be getting liquidated right about now. So I would advise all clients, if you're thinking about something like that, make sure you keep the loan to value ratio super low so that you're not going to get liquidated. There are other things you can do. Borrowing against your Bitcoin isn't the only thing you can do. There are a ton of things, so.
That's good to hear, because it is often presented, I see in a lot of circles, often presented as pretty much the only thing. And there's one big platform out there, I won't name names. They only offer loans at a 50% loan to value ratio, which is a little higher than, it's not the riskiest by Bitcoin standards. Yeah, you should probably aim for more like 20, 30%. And they had, I don't know if this is true or not, but I've heard that they had like 25% of everyone on their platform get liquidated in this last 6 weeks worth of a crash or something. So yeah, that's definitely a risk. If you are going to do it, definitely keep the loan to value ratio low. Only do it against a portion of your holdings, and keep some collateral on the side to top up in case you get a margin call. And so yeah, I totally agree that it's definitely not for everyone. I think it's a little riskier than it's often presented as. People need to understand the risks and the mechanics of how it works. There's also the fact that you give up custody of your Bitcoin. There may be one exception. I think there's one platform out there that somehow allows you to retain custody, and that sounds interesting to me. I don't know all the details there, but in the vast majority of cases, you're going to have to give up custody of your Bitcoin, and then at the same time having the risk of liquidation where you just lose it anyway. So
Bitcoin's volatile. How much leverage do you need on a asset that has 45 vol? So I'm with you. I'm right there with you.
Yeah, got to be careful. And the volatility today, as you know, because you've been around long enough, is not even as bad as it was. I mean, the implied volatility has been pretty declining for quite some time now, which I guess is always going to happen as an asset grows in size and maturity, because it takes more to move the market. But I mean, 40% drops used to happen literally overnight, and now it takes like 3 months. So you talk about diversifying self-custody and counterparty risk. How do you balance sovereignty with being practical and not making things too complicated for the average person?
Yeah, So I don't think not every client should hold 100% cold storage. And I don't think every client should hold 100% in an ETF either. There are a lot of risks with each. And the right answer kind of depends on the person. Some people like the simplicity of having Fidelity manage an ETF for you, and they custody all your Bitcoin for you. You don't have to hold any private seed phrases. And then some people want the sovereignty of holding your own keys. It's not your keys, not your coins. So there's a whole different, and that's the antithesis, that's the main thing of Bitcoin, right? It's to eliminate the counterparties. But if you want to think of it, it's like if you are self-custodying, you are a counterparty, right? You kind of think of it that way. So do you trust yourself with all of your Bitcoin? I don't. So there are a whole bunch of different things. We can do multi-sig, institutional custody. If you want to hold real Bitcoin, if you want to hold something like an ETF and get price exposure, we can do that as well. And it fits right into your 401k or your Roth IRA or whatever else. And then you can hold real Bitcoin. An example I give to people is you hold a third in each. You have the ETF, you're selling calls on it and you're kind of cash flowing it without having to rely on selling your Bitcoin to kind of get some cash flow. Maybe you want some perpetual preferred equities. So you want some Bitcoin exposure in a way that's, maybe not as volatile. And then you want some multi-sig institutional custody, and you want some real Bitcoin yourself that you self-custody yourself. So it's kind of, the key is about reducing single points of failure risk, right? So don't keep all your Bitcoin with one custodian. I wouldn't keep all my Bitcoin with Coinbase, for example. It's don't keep all your keys in one location. So you're kind of diversifying the risk, not just the asset itself. And that's kind of unique to Bitcoin. But, so sovereignty matters, but so does practicality. A 65-year-old retiree probably shouldn't be managing their own multi-sig cold storage setup, but maybe an engineer in their 30s wants to do something like that. So it's like my job is to figure out the right mix for each client.
Yeah, totally agree with that. I mean, as Bitcoiners, we typically preach self-custody and self-reliance and all that, but not everyone is ready for or just suited to that responsibility and the risk that comes with it. I think that's probably a pretty big barrier to adoption overall, is because I've helped, onboard a handful of friends and family members over the years. And when, once their holdings go to a certain point and they start thinking about a hardware wallet, sometimes they just get terrified. They're like, whoa, you mean I have to send this from this platform to my own thing? And if I make one mistake, I could lose everything. And that's tough. And I've always, I'm a majority cold storage guy myself. But yeah, I do keep a portion with a trusted custodian, just because if something happens, I happen to make a mistake, then I don't want to lose everything. And even spread across multiple cold wallets don't even, like, if you have a big enough balance, I mean, you consolidate as much as possible, but it may not always be the best to be, constantly spending from the same wallet that has the majority of your holdings and all that kind of stuff. And multi-sig is a whole nother beast. I mean, it makes sense if you have substantial holdings and you want to protect yourself from $5 wrench attacks and all that type of thing. But it can get complicated. And even if there are services that make it a lot easier now today for just about anybody to hold their coins in multi-sig, but then you have the risks that introduces, and just the complexities, and like, what is going to be your key? Like, for example, there's one of the main custody solution providers for multi-sig out there works with Ledger, the hardware wallet maker, and Ledger has had these updates to their firmware that changes how Bitcoin transactions are signed, some type of security update or something. So then this multi-sig company has to go in and make their own alterations to their software and how it works, so that you can sign one of the 2 of 3 or 3 of 5 keys for your multi-sig wallet. So then it just messes things up. And I think for most people, probably just a mix of your own cold store, assuming you're someone who wants to be sovereign with your own money, control your own savings, and you're mostly just holding spot physical Bitcoin, then in my opinion, it makes sense to just do majority cold storage yourself, significant minority, maybe depending on your own preference, risk tolerance, in some trusted third-party custodian. and just keep it that way. If you want to do multi-sig, be my guest. But in my experience, multi-sig and lending are two very misunderstood things, I think, where it's presented as like this simple, great solution. But when you actually get into the details and the mechanics of it, it's not quite as simple as it's presented, and you can just add additional layers of complexity and risk that don't really serve the average person necessarily. So you've been talking about these different types of Bitcoin exposure, these new things that really didn't exist, say, 3 or 4 years ago. So how do you think about preferred equity, structured exposure, risk managed strategies, and all that inside a Bitcoin focused portfolio? You've already sort of addressed this, but maybe just summarize.
Mm-hmm. Yeah, definitely. So this is such a controversial topic, I feel like, within the Bitcoin community. And it's so interesting to me because, if you think that Bitcoin will succeed as money long term, there will be a credit market built out on it. And so that's how I kind of think about a lot of these instruments, as like credit, right? So people forget, gold, the credit market for gold, I think, was about 3x larger than the spot market for gold. And like nobody really knows that, right? And so if you're going to have adoption of this technology and you want it to succeed, businesses are going to use it. People forget businesses are owned by individuals, right? Bitcoin's not just a thing for individuals. If it's going to succeed, businesses are going to use it. And so that's how I kind of think about strategy, right? And strategy is the main issuer of these perpetual preferred instruments. And there are others too, like Strive and Metaplanet in Japan, but they're pretty early and they're a lot smaller. So strategy is kind of the main one, right? And if you want to think about it like this, is like raw Bitcoin's really volatile. And that's fine. If you have a 25, 30-year time horizon, if you're 22 years old like me, I have no problem holding through the volatility of Bitcoin because I believe in it long term. That might not be fine if you're 60 years old and you need cash flow this year or next year or the year after that. And so how I kind of like to think about strategy is Rockefeller's Standard Oil. He took crude oil, something that was completely useless and viewed as useless by the market, right? Everyone's like, what are you doing with all this crude oil? Like, there's no use for it. And Rockefeller had the vision that he was going to refine all this crude oil into products, like gasoline, like diesel, jet fuel, kerosene, a whole bunch. We make clothes out of some like hydrocarbons. And so I view strategy in kind of that way, right? They're taking that raw, crude Bitcoin and something that maybe, a fixed income portfolio manager is never going to touch, even if it makes sense. They might never touch that, but they might touch something like a product like Stretch, like STRC. It's, roughly 5x over collateralized by Bitcoin on Strategy's balance sheet. It has a yield of around 11.5% right now. That's annualized, but it's paid monthly. And it has significantly lower volatility than holding, crude raw Bitcoin. So it's a completely entirely different risk profile. There's issuer risk, there's counterparty risk with these products, and it's not Bitcoin, right? This doesn't compete with Bitcoin at all. And I think that's where a lot of Bitcoiners kind of get caught up. This isn't competing with Bitcoin. This is competing with all the other junk credit that exists in the market today, right? It's like, you want to know what Blockbuster was collateralized with when it went under? CDs and leaseholds, right? And they were the top dog. They had the opportunity to buy Netflix at the time. It's just like, that's the garbage that exists out there today. It's like, try to find something that's backed with an asset, 5x over collateralized, and that asset's going to be around. There's no physical risk to that asset. There's other risks too, but the main ones like physical risk aren't there. So it's such an interesting concept, this digital credit idea. That's kind of what it's being branded as and called. It's digital credit. So yeah, you can really get Bitcoin exposure and benefit from Bitcoin in a risk profile that matches your actual life. You don't have to ride the full volatility curve to benefit. And I'm the biggest volatility is vitality person out there. So yeah, it's such an interesting new development in the market. I think it's the most interesting thing in the market today. So
Yeah, that's a great overview explanation of that stuff, of all these new things that that are widely misunderstood and not often talked about. But yeah, I like how you mentioned that it's different people, different products are going to be more appropriate for them depending on the situation. I think in general, the younger you are, the more comfortable you are with volatility, most likely for most people. And I was on a podcast, someone else's podcast, like a month ago, and they were saying that their previous guest was a Gen Z person who said they're like burning the fiat boats. They're all in on Bitcoin and they don't care what happens. Like if it goes down, we're going down with the ship, and that's it. So whereas someone 20 years older, probably like that's not an option. That's not something that's really tolerable. Even me now, I actually first discovered Bitcoin when I was about your age. I think I was 23. And yeah, had no problem holding through a good 10 to 12 years of the volatility, really. Now I'm getting older. Now I'm in my mid, going on late 30s. And it just, it's a different feeling. I don't know. It's like, do I want to see this massive portion of my net worth get wiped out in the next bear market? And I just last year, I started having those kind of thoughts for the first time ever, when I was always just like, nope, selling is not an option. I'm like going to sell my shares so I can buy more, if anything, with the dip. I'm not going to, set a stop loss or anything like that. And yeah, it's just interesting how that changes. I may have to even look into some of the things you're mentioning. I've known, like STRC, for example, I've known that's been around, but I never really considered it for myself. And I never really considered diversifying self-custody or diversifying spot really into like ETFs or those other digital credit type products as well. The derivatives on top of it. I think that's the easiest way to understand it, is just those things that are not Bitcoin. They're Bitcoin derivatives in some way. And
Sorry,
yeah, go
keep
on,
going.
go on.
Oh,
I'm
it's
done.
super interesting concept that I like to think about as like as you build the layers, right? So you have the base layer of Bitcoin, and I think it's money, right? It's digital capital. And then you got layer 2, and that's kind of like the credit layer, like STRC, STRK, all these instruments, Strategy, Strive, Metaplanet are building. That's layer 2, right? And then I think you'll have something like a layer 3 built on top of this credit, which is super interesting on top of itself. So Bitcoin, in my opinion, it's such a good transactional asset, except for the fact that it's volatile, right? And even with something like Stretch, like an STRC, it has it's 7, 8, 10% volatility. It's not perfect. You can't use it for true transactions. And it lives inside a brokerage account. So there are those issues as well. But an interesting idea is something like, maybe Morgan Stanley or JP Morgan takes, their savings account and they put it into something like an STRC, and they get 11.5% and they pair it with a cash cushion, and they take the remaining 10%, 7% volatility out of that instrument, and they offer it like a savings account. And they, say it's a 7, 8%, annualized APR savings account. And, they profit between that spread, and they remove the volatility. Something like Venmo could offer that. And you're sending, digital money to each other in a way that, doesn't lose its value. It's not volatile before it gets to that other person. So that's kind of how I think, Bitcoin will be used as a transactional asset in the future. I don't think people will be sending Bitcoin to each other. As cool as it is, and as awesome as that is, I think there will be other products built using Bitcoin that will be used as transactional currencies like that.
Yeah, banks need to get on creating that type of savings account real quick so we can bring back capital and savings. The best deal I've found recently on savings accounts is E-Trade Morgan Stanley has a premium savings account that's like 3.3% right now. And that, doesn't really keep pace with real inflation. Maybe it matches the official inflation rate, but not the real cost of inflation that everyone has to live with. So yeah, that could be another great solution. Bitcoin entering into traditional finance and just making it better. Hopefully that day comes soon. I mean, it's already here in some ways, just still more development to go. Will be interesting to see.
Yeah, this
what
is
the next few
adoption,
years bring.
right? This is adoption.
Exactly. So switch gears a little bit. My last big question is, with AI accelerating productivity and disrupting labor markets, why do you believe owning Bitcoin is even more important today than ever?
This is such a prevalent topic because everyone wants to know about AI. And I get a lot of clients that are coming to me and they're like, what stocks do I buy in order to benefit from AI? And I have such a hard time recommending these hyperscalers that are, the traditional AI names, because they're spending all this money and it's like, where's the moat? How are you ever going to get the revenues back from this investment? How do you differentiate ChatGPT from Google's Gemini? And now Anthropic's Claude is way better. I just switched over from ChatGPT after using it for a couple of years, and I love Claude now. Anthropic's Claude is like the new top dog. And so how do you kind of build your moat around it? And I think Bitcoin is the best expression of the AI trade for a couple of reasons. Let me explain. So number one, I think that AI agents will use Bitcoin, right? They're not going to use banks. They're not going to use PayPal's API and set up a KYC account and figure all that out. And I don't even think they could, right? AIs will need programmable, permissionless money in a way that they can set up their own addresses like that without having any KYC processes, and they can send it to each other without permission. That will be used that will be Bitcoin, right? It won't be a traditional legacy financial product or anything like that. And it's such an interesting thought, like a thought exercise here is like, maybe we look back 200 years from now and, humans were the beta testers for Bitcoin, and 99.9% of transactions in Bitcoin are done via AI. I'm sure if you think that AI will be as transformational as I do, I think entire businesses will be ran with AI, And so if you start going down that rabbit hole, it's like, how are they going to transact value with each other? I don't think they're going to use PayPal's API. I don't think they're going to use Wells Fargo. They're going to use Bitcoin. And this is already kind of happening today. So that's the first reason. And the second, and this is kind of the bigger point too, is the natural state of the free market is deflation, right? And that's a Jeff Booth quote. I'll quote it till I die. I'll say it again. The natural state of the free market is deflation. So technology makes things cheaper. Think about like the TV, right? I bought a TV, or my family bought a TV in probably 2014, and it was one of the brand new smart TVs, and it probably cost $2,000. And I just bought a TV, 75 inches, 4K, and it costs $350. So technology makes things cheaper, right? Your laptops get cheaper, everything gets cheaper. I live in North Dakota. Farming is a huge thing here. The combines and tractors drive themselves. It's like the work that took dozens of people, doing hard manual labor, for centuries is now done by machines. So why is food more expensive? So it's because we live in a debt-based monetary system, right? We have $37 trillion worth of debt. The United States does. The system cannot tolerate deflation, because in that world, if you have deflation, the real debt load gets larger in real terms, right? So you can't have that. Asset prices will fall. Asset prices won't keep going up over time. And that's basically what our entire system is built on. So governments need to print money to keep inflation positive, to offset the real cost of the debt load and make sure that asset prices keep going up, et cetera, et cetera, et cetera. So if you think AI will be this huge productivity boost, I think it'll be the most revolutionary technology and most turbulent thing I will ever live through. I'm sure it's probably been the most revolutionary thing you've ever lived through so far. Productivity gains from technology get absorbed by monetary expansion. We live in the best period in human history ever. Look around. All of our technology is amazing. So why does everything cost more? And that should make you furious. That should make you so mad. We're not able to experience all these benefits that technology brings, and it should be deflationary. Everything should be getting cheaper, but it's not, right? And AI is about to supercharge that. It's about to get so much quicker, right? It's going to get so deflationary. AI will be super deflationary. It'll be like mega deflationary. So costs should go down, right? And I don't think they will, because the money printer will offset it. They're going to just have to print so much money in order to offset these costs that you won't be able to experience the deflation. Maybe you will, but is OpenAI gonna be able to experience that deflation? Is Gemini, Google gonna be able to experience that deflation? I don't know. The consumers, will obviously. So Bitcoin kind of gives you fixed ownership of everything, right? There's only 21 million Bitcoin, so you have a fixed supply. And so you retain your ownership of everything if you own that same fixed supply, that same portion of that fixed supply of Bitcoin. So it lets you experience the deflation that technology should be delivering, right? In 2020, they expanded the monetary supply by 20%. It's like your life savings got 20% worth less in just that one decision. Well, you didn't vote on that. That should make you so mad. So Bitcoin's kind of the opt-out button, right? Step off the treadmill. You're running, you're tired. Step off the treadmill, experience deflation. Your life should be getting a little easier every day. So
Yeah, that's one of the big points I always try to hammer home is that everyone's standard of living would be so much higher today if we just had a hard money standard. If you do the math in terms of gold, there's a Forbes article that was published back in like 2013, 2014. Anybody can look this up. Just search for, I've mentioned it before, Forbes wages gold. I think that should bring it up for you. They did the math of how many ounces of gold per year a minimum wage full-time worker made in 1965. And if you took that many ounces of gold today, even before the recent price rise in gold, you get to a six-figure number that is bigger than most anyone would expect. So that translates to is that a low-skilled worker in the mid-60s made the equivalent of a six-figure salary today, or that highly skilled workers making a high salary today have a similar standard of living as what minimum wage workers had way back then. And so if you would just think about that, like how you're saying, technology, we see the deflation in technology, and that's about it for the most part. That should be happening with literally everything else. So then everyone who's employed would practically have a millionaire standard of living today. And that also leads into the question of, universal basic income. Everybody talks about, well, job losses are happening. It's a lot harder to get a job now. There are not that many new jobs being created from AI. We know this now. I mean, the anecdotal evidence is overwhelming, has been for some time. And now we're actually seeing that in the jobs numbers, in the revisions, that is, there's no like headlines screaming about it necessarily, because the jobs numbers when they come out don't always look so bad. But then months later, they get revised. And looking at those revisions, there's about 2 million jobs that have been lost in this country over the last, I think, 2 or 3 years. And so there's not enough new jobs being created. And then it always gets in the discussion, well, we're going to have to do universal basic income. But there's no way to do that without destroying the value of your currency, because you have to either, if you were able to tax everybody else, maybe it wouldn't destroy the currency, but you can't do that. So you have to print money. It's going to devalue the currency. And then you're just caught in an inflationary death spiral. But what I think of as a potential solution would just be go to a hard money standard. All the prices would fall, and you wouldn't need to print more currency. You wouldn't need to give everyone constant handouts, because it would be much easier for them to afford things. And that's a solution that I don't think is talked about enough, but it's like that with basically everything in the fiat system. We get all distracted with these political issues, many of which might be important in their own right, but don't really get to the root of the problem, which is the money itself. I'm a fan of Jeff Booth too. One of my favorite quotes of his is that when you have corruption at the base layer of money, you have corruption at every level of society. I think that's a nice, concise way of just summarizing the problem, that so many other societal problems stem back to the money printer, the easy money that's backed by nothing and printed infinitely. And like you mentioned, we don't get to vote on these things. It's outside the political spectrum. So all that stuff is kind of a distraction in my view, and getting emotional or deeply involved into politics is not really the solution. If you ask me, it's because the solution to the problems created by this system are not going to come from inside of this system. So that's what I've got. That's my 2 cents. And yeah, we're going to wrap it up here. Charli, if you've got anything to add, go for it. And then let people know how they can get in touch with you and follow you, your work, and your company.
Yeah. A lot of people my age, they blame capitalism for this type of stuff. And I just tell them, capitalism has created an immense amount of wealth over the last 100, 200 years. And the system that we live in today is not capitalism. It is crony capitalism. There's a big difference. Capitalism is very good and it works very well. But crony capitalism, when the money is flawed, works a little bit differently. And you can see how these power starts to centralize. And, it's horrible. And like what you said, the solution, I think, is to get on a hard money standard. And, we don't have to wait for the states, or we don't have to wait for the Bitcoin Act to pass. This isn't a decision that every individual can make themselves today. You can step off the treadmill. So, and that's my job, right? Is kind of get people off the treadmill and get them onto a hard money standard. So, again, I run 21st Financial. If you're ever, if you know of someone who wants to get into Bitcoin and they want it implemented into their existing portfolio in a professional, fiduciary way, I'm your guy. If you're already a Bitcoiner and you're looking to, maybe make some income off your stack and you don't want to sell it, you don't want to rely on selling your stack, I'm your guy there. If you're a 65-year-old retiree and you like Bitcoin, but you don't want to deal with the volatility, there are things to do there too. So I'm your guy. So I appreciate you having me on, Brian. This has been awesome. Appreciate it so much. This has been great.
Thanks, Charlie. Been a great episode. So that's going to do it for this episode of Hard Money Dispatch. Thanks, everyone, for listening. Go ahead and leave us a 5-star review on Spotify or Apple Podcasts or wherever you're listening. If you found value here, if you're watching on YouTube, be sure to subscribe. And I'll leave a link in the description to sign up for the Hard Money Dispatch newsletter. And we'll see you next time.